100 Baggers Stocks That Return 100 to 1 and How to Find Them by Chris Meyer. Chapter 1 Introducing 100 Baggers. This book is about 100 baggers. These are stocks that return $100 for every $1 invested. That means a $10,000 investment turns into $1,000,000. In this book, I want to show you how you can find them. I know. It sounds like an outrageous quest with a wildly improbable chance of success, like setting out to draw a royal flush in poker. And I would probably have agreed with you not so long ago. But then I started to dig in and study these 100 baggers. Definite patterns emerged. Let's set out what this book will do for you. You will learn the key characteristics of 100 baggers. There are only so many ways up the mountain, and we'll map out these paths in what follows. You will learn why anybody can do this. It is truly an everyman's approach. You don't need an MBA or a finance degree. Some basic financial concepts are all you'll need, and you can get them on this channel. I'll share with you a number of crutches or techniques that can help you get more out of your stocks and investing. The emphasis is always on the practical, and so there are many stories and anecdotes to help illustrate important points. You should read this book if you want to get more out of your stocks, or listen to this audio. Even if you never get a 100 bagger, this book will help you turn up big winners and keep you away from sleepy stocks that go nowhere. If you like investing in utility stocks with their limited upsides, then this book isn't for you. This book will change the way you think about investing in stocks. You will never look at the problem in quite the same way again. I hope it will energize and excite you about what's possible. Before I get into the specifics of how to find 100 baggers, let me give you some context that helps frame the whole effort. The story of this book begins in 2011. That year, I read remarks investor Chuck Ackrey made at a conference held that same year. Ackrey is a great investor, and we will meet him again in the last chapter of this book. The title of his talk was An Investor's Odyssey, The Search for Outstanding Investments. Here is a part of what he said. In 1972, I read a book that was reviewed in Barron's, and this book was called 100 to 1 in the Stock Market by Thomas Phelps. He represented an analysis of investments gaining 100 times one's starting price. Phelps was a Boston investment manager of no particular reputation, as far as I know, but he certainly was onto something, which he outlined in this book. Reading the book really helped me focus on the issue of compounding capital. Also, from Boston, you all know of Peter Lynch, who often spoke about 10 baggers. Here was Phelps talking about a 100 bagger, so what's the deal? Well, Phelps laid out a series of examples where an investor would in fact have made 100 times his money. Further, he laid out some of the characteristics which would compound these investments. I had never heard of the book, and I've read all the investment classics and many obscure ones. So I quickly got hold of a copy and began to read. It became one of my favorite investing books. In December of that year, I sat down and wrote the following story for readers of my newsletter. It serves as an introduction to Phelps and the ideas we'll explore more in this book. Every problem is an investment opportunity. Every human problem is an investment opportunity if you can anticipate the solution, the old gentleman told me. Except for thieves, who would buy locks? I just met this remarkable fellow, full of wisdom on investing, yet hardly known beyond a small group of fans. His name is Thomas Phelps, and he's had quite a career. He was the Wall Street Journal's Washington bureau chief, an editor of Barron's, a partner at a brokerage firm, the head of research department at a Fortune 500 company, and finally, a partner at Shooter, Stevens, and Clark, since bought out by Deutsche Bank. Phelps retired in Nantucket after a varied 42-year career in markets. Along the way, Phelps figured out a few things about investing. He conducted a fascinating study on stocks that returned $100 for every $1 invested. Yes, 100 to 1. Phelps found hundreds of such stocks, bunches available in any single year, that you could have bought and enjoyed a 100 to 1 return on if you had just held on. This was the main thrust of our conversation. The key is not only finding them, but keeping them. His basic conclusion can be summed up in the phrase, buy right and hold on. Let's face it, he said, a great deal of investing is on par with the instinct that makes a fish bite on an incredible spinner because it is moving. Investors too bite on what's moving and can't sit on a stock that isn't going anywhere. They also lose patience with one that is moving against them. This causes them to make a lot of trades and never enjoy truly mammoth returns. Investors crave activity, and Wall Street is built on it. The media feeds it all, making it seem as if important things happen every day. Hundreds of millions of shares change hands every session. But investors need to distinguish between activity and results. When I was a boy, a carpenter working for my father made this saga observation. A lot of shavings don't make a good workman. As you can see, Phelps is a man of folksy wisdom. Investors, Phelps continued, have been so thoroughly sold on the nonsensical idea of measuring performance quarter by quarter, or even year by year, that many of them would hit the ceiling if an investment advisor or portfolio manager failed to get rid of a stock that acted badly for more than a year or two. What investors should do is focus on the business, not on market prices. Phelps showed me financial histories of a long list of companies, earnings per share, returns on equity, and the like. No stock prices. After one example, he asked, would a businessman seeing only those figures have been jumping in and out of the stock? I doubt it. But if they just sat on it, they'd be rich. And this is the nub of it. Phelps is not a fan of selling good businesses. He talked about how his friend Carl Pettit, an industrialist, inventor, and investor, sold his shares of IBM stock many years ago to start his brokerage business. He sold them for $1 million. That stake would eventually go on to be worth $2 billion, more than he ever made in his brokerage business. Phelps told me the story of how he sold his Polaroid stock to pay a steep doctor's bill of $7,415 back in 1954. Here is the confirmation of the sale, he said, and he keeps it as a reminder of his folly. Less than 20 years later, his Polaroid stock was worth $843,000. That is an expensive doctor's visit. Phelps also stands against market timing. He told me about how he predicted various bear markets in his career. Yet I would have been much better off if instead of correctly forecasting a bear market, I had focused my attention throughout the decline on finding stocks that would turn $10,000 into $1 million. Because of his bearishness, he missed opportunities that went on to deliver 100 to 1. Bear market smoke gets in one's eyes, he said, and it blinds us to buying opportunities if we are too intent on market timing. He who lives by the sword shall perish by the sword, he added. When experienced investors frown on gambling with price fluctuations in the stock market, it is not because they don't like money, but because both experience and history have convinced them that enduring fortunes are not built that way. Phelps showed me a little table that reveals how much and for how long a stock must compound its value to multiply 100-fold. And the table is returns versus years to 100 bagger. 14% takes 35 years, 16.6% in 30 years, 20% for 25 years, 26% for 20 years, and 36% takes 15 years to 100 bagger. You'll note these are very long holding periods, especially in an age where the average holding period for stocks is measured in months. But that's the point. The greatest fortunes come from gritting your teeth and holding on. You'll also see it's a fairly high hurdle to get to 100 bagger status. You'll need high growth for a long time. For example, Tractor Supply grew earnings at a rate of 23% per year and became a 100 bagger after just 12 years. Later, we'll look at Monster Beverage, a stock that became a 100 bagger in just 10 years, a remarkable feat that required a 50% annual growth rate. Phelps advises looking for new methods, new materials, and new products, things that improve life, that solve problems, and allow us to do things better, faster, and cheaper. There is also an admirable ethical streak to Mr. Phelps' style, as he emphasized investing in companies that do something good for mankind. This requires looking beyond past figures. There is a Wall Street saying that a situation is better than a statistic, Phelps said. Relying only on published growth trends, profit margins, and price-earnings ratios is not as important as understanding how a company could create value in the years ahead. Phelps is quick to add, he is not advocating blindly holding on to stocks. My advice to buy right and hold on is intended to counter unproductive activity, he said, not to recommend putting them away and forgetting them. And so what if you don't get a 100-fold return? The point of Phelps's brilliant teaching method is to focus your attention on the power of compounding, to forget the day-to-day ripples of stock prices. After all, Even if you catch part of a 100 bagger, the returns could fund a retirement. It is an investment tragedy of sort to think people have owned these stocks and not reaped those gains because they were trying to time the market or trade in and out. Sometimes stocks take a long time to get going. Phelps had plenty of examples of stocks that went from nowhere or down for years, but still delivered the big 100 to 1. One of the basic rules of investing is never, if you can help it, take an investment action for a non investment reason, Phelps advised. Don't sell just because the price moved up or down or because you need to realize a capital gain to offset a loss. You should sell rarely and only when it is clear you made an error. One can argue every sale is a confession of error, and the shorter the time you've held the stock, the greater the error in buying it, according to Phelps. I love Mr. Phelps' ideas. They are hard to implement, I know, but some people have. He related the experiences of individuals, former clients, and old associates who got rich by buying right and holding on. Phelps wishes he had learned those insights when he was younger. Now I have a little confession to make about Mr. Phelps. I didn't actually meet him. He's been dead since 1992, having reached the ripe old age of 90. Every quote above comes not from a conversation, but from his book 100 to 1 in the Stock Market. A distinguished security analyst tells how to make more of your investment opportunities, published in 1972. In 2011, I picked up a near mint copy for $22. This forgotten book should be a classic. Do not let the implausibility of making 100 to 1 on your stocks distract you. The main idea is to know how such returns have happened and what investors need to do to get them. Aiming a little closer to that goal is bound to improve your results. Phelps wrote as such, just a slight change in a golfer's grip and stance may improve his game, so a little more emphasis on buying for keeps, a little more determination not to be tempted to sell, may fatten your portfolio. In Alice in Wonderland, one had to run fast in order to stand still. In the stock market, the evidence suggests one who buys right must stand still in order to run fast. It is superb advice. I recommend the book, needless to say, which is a pleasure to read and has plenty of good ideas, analogies, and stories. For a long time, the book was out of print, but in January of 2015, Echo Point Books reissued the title, and you can buy it easily at Amazon. Amazon is also a 100 bagger. We'll look in chapter 5, by the way. Picking up where Phelps left off. Phelps's book was a study of 100 baggers from 1932 to 1971. It is not a study of every 100 bagger because he properly limited his study to cut out the tiniest of stocks, and I doubt even he had the resources to identify every 100 bagger. It is also harder to come up with a definitive list than you'd think. There are complications in how you measure returns. For example, do you measure stock prices annually, quarterly, daily, hourly? You get slightly different results each time, as some stocks may have only reached 100 times for a brief period. Even so, his book lists over 365 stocks. The latest 100 bagger started in 1967. That's a 100-fold return in just 4 years. But again, the cutoff is 1971. I decided to update his study. I started working with Stephen Jones from String Advisors to create a database of every 100 bagger from 1962 to 2014, assuming you'd reinvested the dividends and also making allowances to cut the tiniest stocks. We looked for stocks that had a market cap of greater than 50 million in today's dollars prior to their 100-fold climb. This was a massive undertaking. My publisher spent more than $50,000 just to get the data. My goal was and remains simple. I want to find what these stocks have in common. I want to learn how these spectacular returns came about with an eye towards using those insights in today's market. My new study would be an update of Phelps's work. I expected to reinforce many things Phelps wrote about. I also believed we'd uncover some new insights since our computing horsepower vastly exceeds what was available to Phelps. At the start, too, I wanted to write a new book around the study to be called 100 Baggers. I dedicate the book to the old man Phelps. So here we are. And everyman's approach to huge profits in stocks. When I was younger, I had strong preconceptions about what great investing was all about. It was long-term, focused on the fundamentals, and somehow a branch of Benjamin Graham's and David Dode's celebrated book called Security Analysis, a tree that yielded Warren Buffett and so many other great investors. If you weren't part of this intellectual tradition, you were just doing it wrong. I'm not so doctrinaire anymore. I'll admit there are lots of ways to make money in markets, just as there are many different ways to make a really good pizza. Nonetheless, there is something to be said for a really good pizza that almost anyone can make with the right ingredients, yet many restaurants still screw it up. In the markets, you can find all kinds of crazy success stories, such as the improbable traders of market wizards fame, including Jim Rogers, Paul Tudor Jones, and Michael Steinhardt, or the oddball dancer Nicholas Darvis, famous for his book How I Made 2 Million in the Stock Market, with its equally odd system. These never interested me for many reasons, but one big reason is they struck me as freakish. The gains were enormous, but the process was not replicable, certainly not by the everyman. I had a hard time believing anyone using insights from such financial freaks could really get anywhere. More likely, I imagined following such a path would lead to ruin. But here's where Mr. Phelps is different. As you'll see in the next chapter, anyone can invest in a 100-bagger, and many ordinary people have. Anyone can find them or find close enough approximates. After all, who is going to complain if you only turn up a 50-bagger or even a 10-bagger? Heck, most investors I know are delighted when they double their money in a few years. Studying some of these great successes and the principles behind 100-baggers will help in the effort to find winning stocks today. Not only 100-baggers. Before we get into that, which is the meat of the book, I want to discuss some elements of the study itself. The study, 365 stocks that turned 10,000 into $1+ million. Take note, CD holders. Our study also turned up 365 stocks. By coincidence, the same number Phelps found in his study covering a different time period. This would be the main population of stocks I poked and prodded in the 6 months after we created the database. I wanted to say a few words about what I set out to do and what I don't want to do. There are severe limitations or problems with a study like this. For one thing, I'm only looking at these extreme successes. There is hindsight bias in that these things can look obvious now. And there is survivorship bias in that other companies may have looked similar at one point but failed to deliver a 100-fold gain. I am aware of these issues and others, they are hard to correct. I had a statistician, a newsletter reader, kindly offer to help. I shared the 100-bagger data with him. He was aghast. He related his concerns using a little story. As he wrote to me, let's say I am curious to find out what it is that makes basketball players so tall. So I take DNA and blood samples from the starting lineups of the NBA teams. There's something huge missing here, which is all of the non-tall people. And this is, of course, true to an extent. I'm only looking at 100-baggers, not stocks that didn't make it. However, what I'll present in this book is not a set of statistical inferences, but a set of principles you can use to identify winners. If you've read Michael Lewis's Moneyball, which looks at the principles behind productive baseball players, you know this is a worthwhile exercise. These principles I will share with you are undeniably true as points of logic, and you cannot get a 100-bagger without them. This will be clear to you by the end of this book. We just have to be careful about what lessons we draw from any statistical analysis. So instead, I have made a study more in the spirit of Phelps's original work. His work was more anecdotal than statistical. He relied heavily on common sense and basic truths. This reminds me of The Outsiders by William Thorndike, another important book which we'll get to later. This study is useful in many ways, as I'll argue, but it is not meant as a scientific or statistical study. Investing is arguably more art than science anyway. If investing well were all about statistics, then the best investors would be statisticians, and that is not the case. We're looking for insights and wisdom, not hard laws and proofs. So with that, let's get started. Chapter 2, Anybody Can Do This, True Stories. Because it sounds utterly magical to invest $10,000 in a stock and walk away with $1 million some years later, Phelps emphasized how investing in 100-baggers was something achievable by anyone. One way he did this was to tell stories of real people who managed the feat. I have many examples of my own. When I started the 100-bagger project and began writing about it, I got a lot of email from readers who had netted a 100-bagger. People told me their stories. It is worth sharing a sampling of these early on because they help set the tone. Ordinary people can do this. You don't have to have an MBA or work at a hedge fund. And as you can see, the lessons people drew from their experiences are exactly the ones this book will reinforce. Here's one email. As an active investor and trader for 30 years, I have come to the realization that this 100 bagger approach and philosophy is the way one should approach a lifetime of investing. If one could only receive the proper level of mentoring as a young man to commit oneself to this course. If only I knew this when I started out, I would not only be wealthier, but my quality of life would have been vastly better throughout all of those years. I have had my share of home runs and plenty of disasters. I have spent countless days glued to the computer screen monitoring positions and trades. Over a career of investing and speculating, the only real money that I held on to were in longer term investments. So, my discovery in investing and advice to younger ones who would endeavor to is to study markets and invest in long term enterprises, which have the potential to vastly outpace other companies and industries, and stick with them as long as the theme is intact. Forget about the trading and use the time you would have spent monitoring the trade with your family. It seems so simple, but a few actually ever achieve it. Here is a prime example of what I'm talking about. Back in January 1992, I read the Barron's Roundtable, and Felix Zulauf recommended Potash of Saskatchewan, POT, as a unique way to play the China growth story. It all made sense to me, so I took a modest position. The stock did quite well. I recall I bought it for $2 a share. I held onto it for 3 years and got a 4 to 5 bagger out of it. I was pretty impressed with myself at my acute market acumen. It stalled out eventually, and I sold it around 1996 as I got tired of it treading water. Now, mind you, the original premise never changed. It was always intact, yet I craved new action. If I had held on until the blow off in 2007, I would have had my 100 bagger. If one had bought even earlier, it was a 200 plus bagger. So the lesson is one needs to stick to the original theme, and if it is intact, just hold on. I believe your project is in fact a very achievable objective. One needs to isolate the common threads and place one's bets on the table after much research and conviction, then hold on. That's a good story from someone who has won the wisdom the hard way. He hits on many important themes in this book. I'm going to have my 16-year-old son and my 13-year-old daughter read it, so they'll know it's not just dad saying this stuff. Here's another email. I remember as a kid, my dad used to grumble about my grandmother because she would complain that she couldn't see well and had cataracts. He would say, well, she doesn't seem to have any trouble reading the fine print of the Wall Street Journal when she's checking her Esso stock. That would have been around 1971, and somehow that is still in the recesses of my mind. Now, if one thinks this 100 bagger goal is unachievable, just consider as a young kid if I had just started accumulating ExxonMobil back then. It would not have taken a genius or much of a stock picker gene. Just buy the largest oil stock in the world that had been around for 100 years. Just put your blinders on and keep accumulating over a lifetime. No stress, no white knuckles, since it has a very conservative balance sheet, no high wire act. So where would $1 back in 1971 in Esso be worth today? By my calculations, $418 plus one would have been collecting a juicy dividend all those years. Amazing, isn't it? Everybody has a story somewhat like these. All right, one more, because these are so interesting. In about 1969 to 1970, when a billboard in downtown Seattle read, "Will the last person turn out the lights?" a friend of mine had just sold an apartment house in Seattle and netted about $100,000 after tax. His view was that things couldn't get any worse for Boeing, so he thought, and he bought 10,000 shares at $9.50 a share. Within about 10 years or so, he was getting annual cash dividends for almost as much as he had paid for the stock. This had to be a 100 plus bagger with all of the stock dividends and splits over the years. In 2002, I believe he still had not sold a single share. Key here is the idea that you must sit still. Think of all the reasons to sell Boeing since 1970. Inflation, wars, interest rate worries, economic fears. The list of reasons to sell is always long, but if you've done the job of picking right, you're better off holding on. This reminds me of an anecdote by Chris Middleman, an exceptional investor, published in one of his shareholder letters. An excerpt appeared in Value Investor Insight. Savor this. Imagine if a friend had introduced you to Warren Buffett in 1972 and told you, "I've made a fortune investing with this Buffett guy over the past 10 years. You must invest with him as well." So you check out Warren Buffett and find that his investment vehicle, Berkshire Hathaway, had indeed been an outstanding performer, rising from about $8 in 1962 to $80 at the end of 1972. Impressed, you bought the stock at $80 on December 31st, 1972. 3 years later, on December 31st, 1975, it was $38, a 53% drop over a period in which the S&P 500 was down only 14%. You might have dumped it in disgust at that point and never spoken to that friend again and thought, what a bum this Buffett guy is. I'll never follow him again. Yet over the years, it rose from $38 to $94. By December 31st, 1982, it was $775 and on its way to 223,615 at the writing of this book, a compounded annual return of 20.8% over the past 42 years, and much higher today. I may print out the above and frame it, so anybody can do this. What you need to learn is how to buy right and then hold on. The latter sounds easy, but it's hard in practice. I'll offer a crutch in the next chapter, and later still, we'll deal with how to buy right. Chapter 3, the coffee can portfolio. Have you ever heard of the coffee can portfolio? I was having lunch with Preston Athley, the outstanding investor behind T. Rowe Price's small cap value fund, when he asked me this question. I had heard of it, which I think surprised him a little because I was only 12 years old when the idea came out, and it is not a mainstream idea. I knew all about it, though, because the coffee can portfolio is one of those classic ideas those aficionados of finance don't forget. I want to tell you about the coffee can portfolio. It is an excellent crutch to 100 baggerdom. It will help you hold on. It all began with Robert Kirby, then a portfolio manager at Capital Group, one of the world's largest investment management firms. He first wrote about the coffee can idea in the fall of 1984 in the Journal of Portfolio Management. The coffee can portfolio concept harkens back to the Old West when people put their valuable possessions in a coffee can and kept it under the mattress, Kirby wrote. The success of the program depended entirely on the wisdom and foresight used to select the objects to be placed in the coffee can to begin with. The idea is simple. You find the best stocks you can and let them sit for 10 years. You incur practically no costs with such a portfolio, and it is certainly easy to manage. The biggest benefit, though, is a bit more subtle and meaningful. It works because it keeps your worst instincts from hurting you. In his paper, Kirby told the story about how his idea came out. The coffee can idea first occurred to me in the 1950s, Kirby wrote. Back then, he worked for a big firm that counseled individuals on their investments. He had a client he worked with for 10 years whose husband died suddenly. She inherited his stock portfolio, which she moved to Kirby's care. Looking at the portfolio, Kirby wrote, I was amused to find that her husband had been secretly piggybacking our recommendations for his wife's portfolio. Then I looked at the size of the estate. I was also shocked. The husband had applied a small twist of his own to our advice. He paid no attention whatsoever to the sale recommendations. He simply put about $5,000 in every purchase recommendation. Then he would toss the certificate in his safe deposit box and forget it. This is back when they actually issued stock certificates. In doing this, a wonderful thing happened. Yes, it meant his portfolio had a number of broken stocks that came to be worth $2,000 or so. Small positions, but he also had a few holdings that ended up worth about $100,000 each. The kicker, though, was this. He had one jumbo position of $800,000 that alone was bigger than the total value of his wife's portfolio. As Kirby wrote, it came from a small commitment in a company called Haloid. This later turned out to be a zillion shares of Xerox. That is an inspiring tale, a triumph of lethargy and sloth. It shows clearly how the coffee can portfolio is designed to protect you against yourself. The obsession with checking stock prices, the frantic buying and selling, the hand-wringing over the economy and bad news. It forces you to extend your time horizon. You don't put anything in your coffee can you don't think is a good 10-year bet. Poor Kirby had been diligently managing the wife's account, keeping up with earnings reports, trimming stocks, and adding new positions. All the while, he would have been better off if he'd followed the idler's creed and just stuck with his initial ideas. Why don't more people hold on? Phelps wrote that investors have been conditioned to measure stock price performance based on quarterly or annual earnings, but not on business performance. One memorable example he uses, among many, is Pfizer, whose stock lost ground from 1946 to 1949, and again from 1951 to 1956. Performance-minded clients would have chewed the ears off of an investment advisor who let them get caught with such a dog, Phelps wrote. But investors who held from 1942 to 1972 made 141 times their money. Phelps showed that if you just looked at the annual financial figures for Pfizer, ignoring the news, the stock market, economic forecasts, and all the rest, you would never have sold the stock. It was profitable, though, throughout, generating good returns on equity with earnings climbing fitfully but even higher. Pfizer was a good coffee can stock. And to really emphasize this, think about how some of these that we've talked about so far came during the Great Depression, when a whole generation of people were afraid to even touch the stock market. An extreme coffee can portfolio. Few things are harder to put up with than the annoyance of a good example. Quote by Mark Twain, Pudd'nhead Wilson. Just to give you an extreme example of this sort of thing, imagine sitting still for 80 years. There is a portfolio that makes the coffee can portfolio look impatient. The Voya Corporate Lenders Trust Fund. It was the subject of a story written for Reuters by Ross Kerber. The headline was, Buy and Hold Fund Prospers with No New Bets in 80 Years. Now, I know you have no interest in holding stocks for 80 years. I don't either. In fact, 10 years is pushing it. I know that. Still, that doesn't mean we can't learn something from the story. Here's Kerber. The Voya Corporate Leaders Trust Fund, now run by a unit of Voya Financial Inc., bought equal amounts of stock in 30 major U.S. corporations in 1935 and hasn't picked a new stock since. Talk about set it and forget it. What's so interesting is the story the portfolio tells. It still has some of the same names it had in 1935, DuPont, General Electric, Procter & Gamble, and Union Pacific. But it also has positions that came about through mergers and or spinoffs. For example, it owns Berkshire Hathaway via an original position in the Atchison, Topeka, and Santa Fe Railway. It has CBS via a stake in Westinghouse Electric. It owns Honeywell through a stake in Allied Chemical. It also shares in Foot Locker because that's where a 1935 position in F.W. Woolworth wound up. It owns ExxonMobil and Chevron thanks to an investment in Rockefeller's Standard Oil. There are only 21 names left, as some have gone on to the great big board in the sky, such as American Can and the Pennsylvania Railroad Company. Remarkably, the fund has beaten 98% of its peers over the last 5 and 10-year periods, wrote Kerber. Over the 5-year period ended February 24th, 2015, the fund returned an average of 17.32% a year, including fees, 1.03 percentage point better than the S&P 500, said Morningstar. For the 10 years ended February 24th, the fund returned an average of 9.4% a year, including fees, 1.32% point better than the S&P 500. In fact, it's beaten the S&P 500 for 40 years. The fund's website doesn't go back any further than that, though I wonder what its performance has been like since inception. It is a low-cost fund with a fee of just 52 basis points, or 0.52%. Most funds' fees are triple that, and there are a few capital gains taxes to pay thanks to low turnover. The fund still has to buy and sell to meet redemptions and invest new money. All in all, a remarkable little story about the power of sitting tight in a portfolio of carefully chosen stocks based on a sensible investment strategy. The fund's original sponsor was Corporate Leaders of America. Today, after a series of deals, it's under Voya umbrella. The original fund had a simple mandate, as described in a brochure on the fund's history. The founders of the trust bought equal shares of 30 leading companies in 1935 and decreed they could never be sold. The only exception was companies that went bankrupt, merged, or spun off. You don't find them making any more funds like this, but back in the early days of the mutual fund industry, most funds looked more like it than not. The first open-ended mutual fund in America and the world was Massachusetts Investors Trust, established in 1924, almost 100 years old. And aside, open-ended means you could buy and sell shares of the fund at a price that matched the value of its portfolio. Before MIT came along, funds were closed-ended. This meant prices might not match the underlying value of the portfolio. Disclosures were poor, And as you can imagine, sponsors often manipulated prices to their advantage. MIT was something new under the sun. It promised transparency and fairness. It promised low-cost professional management for the small investor. It had a sensible and conservative investment policy with a focus on large dividend-paying stocks. MIT would not trade these stocks, but aim to buy and hold. As the late great Professor Louis Lowenstein of Columbia University wrote, the transparency and flexibility and the security and comfort thus offered to small investors made MIT a uniquely American contribution to finance. Good ideas usually have simple beginnings. It's the very simplicity of the concept that makes them ultimately successful. This one was brilliant. Lowenstein told MIT's story well in his book, The Investor's Dilemma, which I highly recommend to anyone who invests in mutual funds. By the way, me personally, I don't recommend mutual funds at all. ETFs all the way. Lowenstein is also the author of my two favorite books on corporate finance, Sense and Nonsense in Corporate Finance, and What's Wrong with Wall Street. Like Voya, MIT held onto stocks for a long time. In 1949, the average holding period was 27 years. Note, this is an implied holding period based on the fund's turnover. In 1949, the fund was not yet 27 years old, and it attracted like-minded investors. Redemptions were less than 3% per year. The fee was only 40 basis points or 0.4%. By 1960, the fee would drop to just 19 basis points. But unlike Voya, this table has a sad ending. MIT's story also illustrates another old truism. Wall Street often turns good ideas into bad ones. It would soon corrupt the simple, brilliant idea of the open-ended mutual fund and turn it into just another money maker for Wall Street. The problem with MIT from Wall Street's perspective is that nobody could make any money off of it, except the investors in the fund. What a novel concept. So somehow, somebody convinced MIT to take on an external manager in 1969. Before that, MIT had its own managers in-house. This was the beginning of the end. With an external manager, the fee started to go up. By 1969, the fee was up 36-fold, while assets under management were up just 7-fold. The external manager also managed the fund more aggressively and traded more frequently. A sad decline set in. By 2004, BlackRock bought the fund and merged it with others. MIT was no more. The typical fund these days charges a lot, trades way too much, and trails the market badly. Lowenstein wrote in his book that the average fund has 160 stocks and turns them over every year. That's not investing, but Wall Street makes money. The establishment doesn't want you to just sit on carefully chosen stocks. It wants to charge you fees. It wants to sell you stuff. This brings us back again to the Voya fund. MIT's tale makes it seem all the more incredible the Voya fund lasted as long as it has, with its initial mission intact. It's a special fund, a piece of Americana. Okay, so maybe you don't hold stocks for 80 years, and maybe my coffee can approach with its 10-year holding period is still too long-term for you. But there is surely some young person in your life whom you can share the wisdom of long-term investing with. Tell them about the coffee can idea. Tell them the story of the Voya fund. Make them wise to the ways of Wall Street. Regarding these extreme holding periods, a reader wrote to me the following. So my thoughts are that this coffee can is a nice way to leave a legacy for my children and grandchildren. I am 66 years old and 35-year investments. I know that you can consider coffee can 10 years, but it seems to be that the longer you can go, the better it gets. Are probably not a good idea now. I was intrigued by the fund that invested in a basket of stocks in 1935 and never touched it again. I am not sure how one would do this now, but it is an approach that saves us from ourselves. The question, how would you go about identifying companies for a 35-year coffee can? When I looked at your list of the best performers, almost all of them were over 25-year or greater returns. If I had tried to pick long-term investments in 1970, my guess is that I would have invested in stocks like Sears, GE, US Steel, Westinghouse, Exxon, and such members of the Dow. Some would have been okay, such as GE and Exxon, but there would have been no investments in Walmart, Apple, Microsoft, etc., and some would have been bad. Would we be better off buying shares of wise investors such as Buffett and sitting on those? The downside is that none of the current wise guys will be around in 35 years either. The questions raised are difficult to answer, especially now because things change so quickly. For example, take a look at the average lifespan of a firm in the S&P 500 index. It is now less than 20 years. See the chart on the next page. The average lifespan was 61 years in 1958, so things have changed a great deal. At the current rate, InnoSight estimates 75% of the current S&P will be replaced by 2027. Leaving the S&P doesn't mean the death of the firm, but unless there's a buyout, S&P usually kicks you out only when you were in trouble. For example, Circuit City, the New York Times, Kodak, or Bear Stearns, which got bought by JP Morgan. Or they kick you out when you get too small, which is another way of saying you underperformed. Although dropped stocks tend to outperform in the first year after being dropped, excluding those bought out. We'll hold out our hope for stocks like Tattooed Chef. Average company lifespan on S&P index in years. And the chart goes from 1960 all the way to 2025, which is projected data. I'll show you one more chart to make a point. Here is the average asset life of US firms by sector as of 2013. Information technology, 6.6 years. Healthcare, 11.4 years. Consumer discretionary, 12.4 years. Consumer staples, 15.1 years. Industrials, 15.4 years. Telecommunication services, 16.1 years. Energy, 17.6 years. Materials, 18.6 years. And utilities, 29.4 years. This table comes from a report by Michael Mauboussin, published in 2014 and titled A Long Look at Short-Termism. Mauboussin is an investment strategist and author of several well-regarded books and research papers. He wrote, "The average asset life of companies in the US is shortening, and more and more firms are in shorter asset life industries," Mauboussin concluded. Shorter asset lives suggest shorter time horizons over which managers should invest, a reasonable reflection of the business world. Executives of many technology companies, for example, can't plan for decades in the way a utility company can because the rate of change is simply too fast. So, 35 years is probably too long a horizon to plan over. This creates some tension with the 100 bagger idea. There is a tension between holding on and the potentially destructive effect of time. Nothing lasts forever. We'll look at what kind of companies to focus on in the next chapter, but we're not yet done exploring the coffee can idea. The biggest hurdle to making 100 times your money. The reason I spend a lot of time here at the beginning showing you the power of long-term investing is because it's really important. The biggest hurdle to making 100 times your money in a stock, or even just tripling it, may be the ability to stomach the ups and downs and hold on. The coffee can is a foolproof way to inoculate yourself against those sickening ups and downs. And I'm sure you've seen some big moves in the overall market in your time. The urge to grab a quick gain or let go of a loser is strong. We're like the little kids in those famous experiments who can't resist eating the marshmallow in front of them, even when promised 2 if they wait 5 minutes. Even the best investors have their share of stories of when they couldn't wait. One of the best is from Warren Buffett. A reader and friend of mine sent me the following example from Buffett's 1995 letter to Berkshire Hathaway shareholders. "I first became interested in Disney in 1966 when its market valuation was less than 90 million. Even though the company had earned around 21 million pre-tax in 1965 and was sitting with more cash than debt. At Disneyland, the 17 million Pirates of the Caribbean ride would soon open. Imagine my excitement, a company selling at only 5 times rides. Duly impressed, Buffett Partnership Limited bought a significant amount of Disney stock at a split adjusted price of 31 cents per share. That decision may appear brilliant, given that the stock now sells for $66. But your chairman was up to the task of nullifying it. In 1967, I sold out at 48 cents per share. He made a 55% gain, but what a costly sale that was. The problem isn't only that we're impatient, it's that the ride is not often easy. This reminds me of a story from 2012 by fund manager Dan Oliver at Merkican Capital. He pointed out that Apple, from its IPO in 1980 through 2012, was a 225 bagger, but those who held on had to suffer through a peak to trough loss of 80% not once, but twice. The big move from 2008 came after a 60% drawdown, and there were several 40% drops. Many big winners suffered similar awful losses along the way. Author Barry Ritholtz, in a column in the Washington Post, had many more examples. Netflix, which has been a 60-bagger since 2002, lost 25% of its value in a single day, 4 times. On its worst day, it fell 41%, and there was a 4-month stretch where it dropped 80%. And yet, you can't just hold on to everything. Lots of big winners have gone completely bust. Ritholtz mentioned a few: Lehman Brothers, WorldCom, Lucent, and JDS Uniphase. I'm sure we would come up with more. So it takes patience, some savvy stock picking, and, as with most things in life, some luck. People who held onto Apple for the whole ride had no way of knowing about the iPod or iPhone or iPad. These things didn't exist for decades during Apple's run. This is where the idea of a coffee can portfolio can help. You don't have to put all your money in a coffee can portfolio. You just take a portion you won't need for 10 years. I bet the final results will exceed those from anything else you can do. A coffee can for the apocalypse. You might think a coffee can portfolio depends on an optimistic view, a la the one Warren Buffett expressed in his 2015 annual letter. It doesn't. You can have quite a dim view of the world, and still, I'd recommend you build a coffee can portfolio. Below, I'll explain why. But first, a bit on Buffett's optimism. I read his annual letter. I also read a lot of commentary on the letter. One of the more interesting criticisms comes from SNL financial columnist Ada Lee. She writes, "The greatest flaw in the letter is the same as last year's greatest flaw. Buffett is given to expressing bullishness on America's prospects in a way that seems almost designed to instill precisely the sort of complacency that poses the greatest risk to that bullish view." In the letter, Buffett writes how he always considered a bet on ever-rising U.S. prosperity to be very close to a sure thing. Indeed, who has ever benefited during the past 238 years by betting against America? To that, Lee has a good response: nobody. Unfortunately, that sort of statement is completely true right up to the day it is completely false. One might have said the same thing about Athens right up to the start of the Peloponnesian War, or Rome through the rule of Augustus, or even the Soviet Union up until around 1980, after which a great many people benefited immeasurably by betting against those states. So that sets the table for thinking about a future that might not be quite as prosperous. What do past calamities tell us about the preserving wealth? Many have tried to answer it. The first guy I thought of was the late Barton Biggs. He was a longtime strategist at Morgan Stanley and then a hedge fund manager and author. Hedgehogging is his first best book worth reading. But Biggs was something of a catastrophist. History's periods of great wealth destruction, where the 4 horsemen of the apocalypse ran wild, transfixed him. He worried about disasters happening again. He asked the timeless question, how do you preserve wealth in times when the 4 horsemen are on the loose? It was one of those 2 questions that, in his own words, long obsessed him. The other was whether the stock market was wise in its judgments or merely foolish, a foolish consensus of crowds. One of his books, Wealth, War, and Wisdom, dealt explicitly with these questions through the lens of World War II history, a hobby interest of his. On the wisdom of crowds, Biggs found that the stock market of the world showed surprisingly good intuitions at the epic turning points. As the old saying goes, when coming events cast their shadows, they often fall on the NYSE, or New York Stock Exchange. He wrote how the British stock market bottomed in 1940, just before the Battle of Britain. The US market turned forever in late May 1942, around the epic Battle of Midway, and the German market peaked at the high water mark of the German attack on Russia, just before the advanced German patrols actually saw the spires of Moscow in early December 1941. Those were the 3 great momentum changes of World War II, he wrote, although at the time, No one except the stock markets recognize them as such. I must admit, those are amazing intuitions. It's easy to write off the market as nutty when it doesn't agree with you, but Biggs made the case that the collective judgment of the market can be wiser than we allow. In any event, this is tangential to what I consider the meaty second question. The second question dealt with how to preserve wealth when the four horsemen are on the loose. Biggs went on through a lot of World War II era carnage to find answers. You'll find such chapters, headings, and subheads as Preserving Wealth in a Time of Cholera, The Plunder of Land in Poland, The Seizure of Estates in Hungary, The Theft of Land and Valuables in Czechoslovakia, and Rape and Robbery by the Red Army. And yet, after all that, even the catastrophist Biggs recommended putting 75% of your wealth in stocks. Take notes, people that didn't grow up in the Great Depression, and CD holders. This is partly because his own understanding of the history of catastrophes validated such a move. Stocks were still often the best way to preserve purchasing power over a period of years, even in devastated Germany. But it is also because he understood the best shot you have at growing your wealth is to own stuff. You want to be an owner. Sound familiar, huh? If you own stocks, you are part owner in a real business with real people trying to figure out things and with real assets and real profits. Ownership of assets is your best long term protection against calamity. But what to do with the other 25%? Biggs recommended a much smaller part of your wealth go toward a ranch or family farm. He advocated a safe haven, well stocked with seed, fertilizer, canned food, wine, medicines, clothes, and so on. This survivalist stuff is not my main idea. I just want to make the point that in real collapse, your portfolio will probably be among the least of your worries. But at least in a calamity like World War II, stocks were your best bet. So let's pull this back to the coffee can idea and think about a coffee can for catastrophists. First, your coffee can doesn't have to include stocks. You could, if you were so inclined, stuff your coffee can with gold. I wouldn't do that. But the point is, the coffee can idea is not an expression of Buffett like optimism on America. You could put whatever you want in your coffee can. The essence of the coffee can idea is really that it's a way to protect you against yourself from the emotions and volatility that make you buy or sell at the wrong times. Bullishness or bearishness doesn't enter into it. If you are a bear and abstain from using a coffee can, you're basically saying you'll make a series of better short term decisions over the next 10 years than you would if you just sat on your best ideas today. That seems unlikely given all the research that shows how most investors trade too much and how it hurts their returns. Put another way, the theory behind the coffee can says your series of shorter term decisions is likely to be worse than one decision today. It might not turn out that way, but it is independent of whether you think the world will be less prosperous in 10 years. If the world is worse off in 10 years, that will affect all strategies. It's not as if you can say, well, I think the United States is going to be the next Argentina, and hence I won't use the coffee can. The conclusion does not follow from the premise. You still have to decide what to do. And as I've said before, you don't have to put all of your wealth in a coffee can. I've told people they only need to put a part of their money in a coffee can. It doesn't have to be the only approach you use, but it can be one of several. In summary, don't let the fear of apocalypse keep you from building a coffee can portfolio. A footnote to the coffee can portfolio. I love the coffee can concept, and one of the reasons is that anyone can use it. It melds perfectly with the idea of 100 baggers because if you truly want 100 baggers, you need to give stocks some time. We'll cover this more later, but since 1962, there have been only 20 out of 365 included in my study that did so inside of 10 years. But if you do give your stocks time to marinate, the result can be mind blowing. And when you think about it, it is not really that hard to simply not sell. I have to share a few more stories from real people who resisted selling and accumulating small fortunes. Here is a coffee can story for you. My brother and I were heirs to 2,000 shares each of Praxair in 1998. I believe it was worth about 34,000 at the time. I did not reinvest the dividends. I wish I had, but adjusted the purchase price by the amount of the dividends received each year. I stopped doing the adjusting when the imputed price had dropped to 120 a share. Didn't want it to go below zero. The price is now $126, so this effectively meets your criterion of a 100-fold increase, even if the stock price itself has not gone up 100-fold. The stock actually was probably purchased by my dad at a price close to the $1 mark. The total value is now over $250,000. I find these stories inspiring. I also like the homespun quality of the stories. The above letter writer is not a hotshot hedge fund manager. He's just a normal guy who held onto a stock. Here's another one. I am very interested in the coffee can scenario because my personal experience is that this is the only way I really make money. I have two hits and one huge miss over the years that would have been coffee can type investments. My first hit was a $200 share, or excuse me, a 200 share investment in a small startup called Micro Systems. I paid $1.30 for the shares. It grew and split several times since I bought in 1981 or 82, something like that, and was purchased last year by a large tech firm. I received 54,000 for my stock. The second was 3,500 in General Electric stock. I was an employee for 3 years and invested through payroll, withholding which GE matched. That investment grew to over 125,000. The bottom line was buying and leaving it alone. The one huge miss was Telefonos de Mexico. I bought 600 shares of this in 82 and sold it when it doubled. Boy, was that a mistake. If I had left it alone, well, you would think the strategy would have greater appeal than it does. After all, how many people want to spend a large part of their time following ticker symbols, anxiously watching blinking lights on a screen, and following the ups and downs of the market? It seems to me a better existence to instead know what you own and then really own it as you would a rental property. Then you go about your life without all the baggage and worry that comes from sweating over the day to day or month to month value of your portfolio. Here's a story that includes a good point on the 100 bagger theme. 100 baggers, I thought you might be interested in my one experience with a 100 bagger. In 1987, I invested equal amounts in 10 high tech or biotech companies that had fabulous stories, and that if they could actually get their products or software to market would be huge winners. Well, I tried to be somewhat smart in picking them, but 9 of the 10 went completely under, and in a not very long time either. There were myriad of problems, but most had to do with being undercapitalized. The 10th one, a startup named Amgen, hit it and not only made up for the other 9 total losses, but returned 800 times my total investment before I had to sell it to send my kids to college in 94. Wish I still had it. Two takeaways for me here. You must pick a compelling story or leader or country and you must use the money you can afford to lose because you must be willing to risk it all of it. This is a good point and bears repeating. With a coffee can, you are allowing yourself to potentially lose everything on a single position. But the idea is that the returns on the overall coffee can portfolio more than make up for any such disasters. I don't recommend taking on startup risks in your coffee can. I would stick with more established companies with long runways of growth ahead and the ability to keep compounding capital at a high rate. Now that you know to hold on, let's turn to what kind of stocks you want to put in. Let's look at those 100 baggers. Chapter 4, Studies of 100 Baggers. Finally, there have been a number of prior studies of 100 baggers, besides Phelps's excellent book. I don't know whether I've found them all, but I've found a few. In at least a pair of them, Phelps was an inspiration. There are, of course, countless studies on stocks that outperform, but here I'm focusing specifically on the 100 bagger phenomenon or close likeness. I want to highlight some of these because they lay more groundwork for what follows, and many of the principles uncovered here are ones I'll emphasize later. There are only so many paths to 100 baggerdom, and these trailblazers, including Phelps himself, have helped map out the territory. Tony's 100 baggers. A fellow named Tony at TS Analysis published one informal 15-page study called An Analysis of 100 Baggers. You can find it free online. I am not an investment advisor or financial analyst, Tony writes, just a guy who likes to analyze stocks. He looked at 19 such 100 baggers. He drew four conclusions, which I excerpt below. The most powerful stock moves tend to be during extended periods of growing earnings, accompanied by an expansion of the PE ratio. These periods of PE expansion often seem to coincide with periods of accelerating earnings growth. Some of the most attractive opportunities occur in beaten down, forgotten stocks, which perhaps, after years of losses, are returning to profitability. During such periods of rapid share price appreciation, stock prices can reach lofty PE ratios. This shouldn't necessarily deter one from continuing to hold the stock. Hansen Natural, now Monster Beverage, is a classic illustration of those points. Tony showed how earnings growth rates went from negative in 2001 to 0% in 2002. From there, earnings increased on a quarterly basis by 20%, 40%, and then 100%. In 2004, quarterly earnings growth accelerated to 120% and then 150%, 170%, and finally 220% by the fourth quarter. Meanwhile, the price to earnings ratio also ramped up. In 2001, earnings were just 4 cents per share and the stock had a PE of 10. By 2006, earnings were about $1 per share and the PE was 50. Think about that. Earnings went up 25-fold, but thanks to the market putting a bigger multiple on those earnings, the stock went up 125-fold. We'll look at Monster Beverage in a more detailed approach in the next chapter. Growth, growth, and more growth are what power these big movers. There was a good case study of a 100 bagger recently posted on the Microcaps Club's website by Chip Maloney. This is worth spending a little time on and illustrates Tony's principles. Maloney reviewed MTY Foods, which is a Canadian franchisor of quick service restaurants such as Thai Express, Extreme Pita, and TCBY. In 2003, MTY Foods had a $5 million market cap. Every dollar invested in MTY Foods then was worth $100 by 2013. The question Maloney asks is the question I've asked myself many times in writing this book. Essentially, how did this 100 bagger become a 100 bagger? In this case, the story begins with Stanley M.A., who became president of the company in 2003. MTY had a fast food franchising business, and M.A. was the entrepreneur who started the company's very first restaurant concept, Tiki Ming, Chinese cuisine, in 1987 as a recent immigrant to Canada. What's most remarkable about this is M.A. bought 20% of the company when he became president, although he owned 29% of the firm. As an owner-operator, he had every incentive to make the stock work. Maloney goes through a number of reasons why MTY was successful. It starts with MA, but it was a remarkable opportunity on many other levels as well. Here are a few attributes I've chosen from Maloney's more extensive list. Stock traded for 2 times forward earnings, cheap. Business was a cash cow with 70% gross margins. Long runway. MTY was just a tiny fraction of the fast food industry. MA created new restaurant concepts, 5 all told, and bought others, 19 eventually. The names and details are not important. What's important is that these new and acquired concepts allowed MTY to increase its number of locations. These businesses generated high profits. So taking those profits and reinvesting them created a flywheel of rapidly growing revenues and earnings. You can see this clearly in the table on the next page, MTY's path to coveted 100 bagger status. Maloney makes an interesting observation here. Earnings per share grew by a factor of 12.4x. But if the company only grew earnings by 12.4x, how did the stock grow 100x? The answer lies in the price to earnings multiple expansion. Investors in MTY went from paying roughly 3.5x earnings when it was left for dead in 2003 to a more optimistic 26x earnings in 2013. And here's the table, MTY's path to coveted 100 bagger status. And it illustrates that from 2003 to 2013, revenues, earnings per share, number of locations, and share price increased exponentially. So again, You need huge growth in earnings, but the combination of rising earnings and a higher multiple on those earnings is really what drives explosive returns over the long term. And in this case, a long term wasn't really all that long, just 10 years. I call these two factors, growth in earnings and a higher multiple on those earnings, the twin engines of 100 baggers. We will come to this point again. Microcaps and 100 baggers. As usually defined, a microcap is a stock with a market cap of less than 300 million. Microcaps actually dominate the market in terms of number of stocks. There are about 16,000 publicly traded stocks in the United States. About 7,360 are under 500 million. From there, here's how the market caps break down from Dave Gentry's book, Microcap Superstars. 7,360 under 500 million, 6,622 under 250 million, 5,713 under 100 million, 5,053 under 50 million. That means at least 40% of the companies in the market are microcaps. This is a vast area to explore. And somewhere in this mix are tomorrow's big companies. I'm stating the obvious, but many big companies started out small. Gentry lists among these following. Starbucks began in 1971 in Seattle as a small store selling coffee beans and today is worth 76 billion in the stock market. Apple began in 1976 in a garage with 10,000 to investment and today is worth 766 billion at the time of this book. It's actually like 2 trillion now. Subway began as a single sandwich shop in Bridgeport, Connecticut, and a $1,000 investment, and today generates over 9 billion in sales in over 35,000 locations. You get the idea. Small companies can grow to 10 times or 20 times and still be small. They can even become 100 baggers. Apple today, by contrast, has a 766 billion market cap, and it keeps rolling, as I said, over 2 trillion today. We can safely assume it won't go up 10 times or 20 times and certainly not 100-fold. You never know, though. Apple, every time it splits, it always goes right back to that pre-split price. The alchemy behind 100 baggers. My focus is on the US market, but I've wondered what such a study might look like in other markets. Fortunately, one such study exists. A firm called Motilal Oswal put together a study of 100 baggers in India. Published in December 2014, the authors of the report also found their inspiration in Phelps's work and dedicated their report to him. It's a fine report, and there is much wisdom in it. Very few investors even conceptualize their equity investment multiplying 100 times, they wrote. Even fewer actually experienced a 100-fold rise in the price of their stocks. This is because such 100-fold rises may take longer than 3, 5, or even 10 years' time, and holding on to stocks beyond that period requires patience. Indeed, it does, as you well know by now. Nearby is a chart that neatly plots the returns required and the years needed to reach 100 bagger status. Years it takes for 100x at different rates. 5 years at 94, 48 for 10 years, and so on and so forth. You don't have to hold onto a stock for 20 years to get a 100 bagger, but the idea is to show you the power of long-term compounding. To harness that power takes some time. The Oswald study found 47 enduring 100 baggers in India over the past 20 years. It excluded fleeting bubble-like stocks. What's shocking is that the Indian stock market as a whole is a 100 bagger relative to 1979. The BSE Sensex has a base of 100 for the year 1979. The Oswald report noted, the Sensex first touched 10,000 in February 2006. That's a 100 bagger in 27 years, or 19% annually. As I write, the Sensex is at 27,000. What I find most interesting are Oswald's conclusions. After all, the aim here is to apply what we learned from the study to help us find 100 baggers today. Based on my work and Phelps's, it's easy to grow with Oswald when he wrote the single most important factor in growth in all its dimensions: sales, margin, and valuation. Most 100 baggers had huge growth curves in these areas. Studying 100 baggers then comes down to studying growth, how it happens, and how it endures, as it must to reach the heights of 100 baggerdom. As the chart shows, a 21% annual return gets you there in about 25 years. That's about the average 100 bagger in my study. But there are other ingredients as well. Our analysis of the 100x stocks suggests that the essence lies in the alchemy of 5 elements, forming the acronym SQGLP, they wrote. S, size is small. Q, quality is high for both business and management. G, growth in earnings is high. L, longevity in both Q and G. P, price is favorable for good returns. Most of these are fairly objective, save for assessing management. In the ultimate analysis, it is the management alone which is the 100x alchemist, they concluded. And it is to those who have mastered the art of evaluating the alchemist that the stock market rewards with gold. That's one reason why I focus on people, which we'll get into more in a later chapter. Investing with top entrepreneurs and owner operators gives you a big edge. And when you mix that talent with the other elements, you are on your way to big returns, if not 100 baggerdom. You can find the 48-page report on Indian 100 baggers free online. Just search for Motilal Oswal 100x and it will come right up. Martelli's 10 baggers. Another study forwarded to me by its author is a 45-slide presentation called 10x Return Stocks in the Last 15 Years by Kevin Martelli at Martech Partners. Martelli presented it at the Value Investing Seminar in Trani, Italy, July 17th and 18th, 2014, almost 9 years ago to date. Although not focused on 100 baggers, he found his inspiration in the same place I did, in Thomas Phelps's book, 100 to 1 in the Stock Market. Martelli cited George F. Baker, 1840 to 1931, dictum mentioned in Phelps's book that summarizes the idea: to make money in stocks, you must have the vision to see them, the courage to buy them, and the patience to hold them. According to Phelps, patience is the rarest of the three. Martelli's study, as the title suggests, looks at 100 baggers over the last 15 years. He screened from about 21,000 listed companies with a market cap of at least 100 million. Out of this sample, he discovered 3,795 stocks, 18% of the initial sample, that returned 10 times. He found, as I have, that many were unpredictable, so he selected with a great degree of subjectivity a sample of 100 more predictable multi-bagger stocks, which a rational and long-term oriented investor had a reasonable chance to identify, purchase, and hold over the long term. It's a good study. Some conclusions. There is no magic formula to find long-term multi-baggers. A low entry price relative to the company's long-term profit potential is crucial. Small is beautiful. 68% of multi-baggers in the selected sample were trading below a $300 million market cap at their low. They were microcaps, actually. Great stocks often offer extensive periods during which to buy them. Patience is critical. I'd add that many of his chosen stocks had top management teams that made good capital decisions about how to invest company resources. There was often a large shareholder or an entrepreneurial founder involved. These can overcome the growth hurdle. One interesting example here is AutoZone. It was a 24-bagger in Martelli's study despite registering ho-hum growth rates of 2 to 5%. Yet AutoZone bought back huge sums of stock, which powered earnings per share growth of 25% a year. This is a topic we'll tackle more in Chapter 11. Heiserman's Earnings Staircase. Another study is by Hewitt Heiserman Jr. titled Ben Graham and the Growth Investor. Heiserman forwarded me his 50-slide presentation. He started by recognizing the attractions of investing in a powerful grower and sitting on your investment. A few of these attractions are the following: you can defer capital gains, you can trade less, you don't have to worry about timing. Heiserman's study is not a 100-bagger study, but his emphasis is on growth stocks that became multi-baggers. But what about all those studies that show how value investing beats growth investing? Well, that's because of the traps. An obvious trap is that investors often overpay for growth. It might seem with 100 baggers that you don't have to worry about the price you pay. But a simple mental experiment shows that this isn't quite right. Let's say we have two companies, A and B. Both start with a dollar in earnings per share. Both will earn $20 in earnings per share in their 20th year. And let's say at the end of year 20, both stocks will trade for $500 per share or 25 times earnings. Now, let's say in year 1, you can buy A for 5 times earnings or $5 per share, and B you can buy for 50 times earnings or $50. At the end of 20 years, you'll have a 100 bagger in A. Earnings will have gone up 20-fold and the price earnings ratio 5-fold. The combination gets you a 100 bagger. In B, you'll have a 10 bagger for after 20 years. That's not bad, but it's way worse than a 100 bagger. A $10,000 investment in A will turn into $1 million at the end of 20 years. A $10,000 investment in B will become only $100,000. So it may seem that the price paid did not matter. Certainly, few would complain about a 10 bagger, but the truly big return comes from when you have both earnings growth and a rising multiple. Ideally, you'd have both working for you. My thought experiment might be extreme, but it serves to make the point that you can't just willy nilly buy pricey growth stocks and expect to come up with 100 baggers. Another trap is that earnings alone has many limitations. Heiserman shows the following. Number one, earnings omits investment in fixed capital, so when capital expenditures are greater than depreciation, the net cash drain is excluded. Number two, earnings omits investment in working capital, so when receivables and inventory grow faster than payables and accrued expenses, the net cash drain is excluded. Number three, intangible growth producing initiatives such as R&D, promo, advertising, and employee education are expenses, i.e., not investments, even though the benefits will last for several accounting periods. Number four, stockholders' equity is free even though owners have an opportunity cost. In other words, companies can spend $50 to create $1 in earnings. If all you look at is earnings per share, then you will ignore the cost to generate those earnings. That's why critical thinking is so important. The point here is you can't focus on earnings alone. I don't want to get into the ins and outs of accounting and security analysis in this book. For one thing, there are plenty of basic books that will teach you why the above is true. Phelps recommended Benjamin Graham and David Dodd's security analysis for those who want a textbook on security analysis. And 43 years later, that recommendation is still a good one. But secondly, the quest for 100 baggers isn't about security analysis per se. Conceptual power is more important. There is no amount of security analysis that is going to tell you a stock can be a 100 bagger. It takes vision and imagination and a forward looking view into what a business can achieve and how big it can get. Investing is a reductionist art, and he who can boil things down to the essential wins. What security analysis can do is weed out the duds, those companies that don't create value even though they show great growth and earnings. I'll have shortcuts to ways of thinking about these problems later in the book. But to get back to Heiserman, Heiserman found a bunch of great examples of multi-baggers. It reads like a greatest hits collection from the stock market. Microsoft, Cisco, Dell, Chico's, Google, Paychex, Hansen, and more. He says earnings just seem to step higher and higher, like going up a staircase. All of these studies show us that past multi-baggers enjoyed strong growth for a long time. In the next chapter, let's look at what I discovered when I looked at that population of 100 baggers I pulled from 1962 through 2014. Chapter 5, the 100 baggers of the last 50 years. At this point in our study, we've already accomplished a lot. I've introduced you to the remarkable Thomas Phelps and some of his wisdom and ideas. You've also seen how ordinary people can achieve the lofty returns of 100 baggerdom by simply holding on to good stocks. And we've chased out the basic outlines of what a 100 bagger looks like. A 100 bagger is the product of time and growth. To net a 100 bagger, you need to hang on to a quality stock for a number of years. I like to emphasize the hard mathematical reality of turning 10,000 into 1 million. In fact, there's another fact about the pattern of 100 bagger returns you should know. If you buy a stock that returns 20% annually for 25 years, you'll get your 100 bagger. But if you sell in year 20, you'll get only about 40 to 1 before taxes. The last 5 years will more than double your overall return, assuming the annual return is constant. So you must wait. This is not to discourage you. You can earn great returns in less than 20 years, but I want to get you to think big. As an aside, holding on is the most tax-efficient way to invest since you don't pay taxes on any gains. Instead, allowing gains to compound tax-free. Consider an example courtesy of Chuck Ackrey, who I mentioned in the first chapter. Let's say Mr. Jones and Mr. Smith each invest $1 million in Berkshire Hathaway in 1977. A superpowered stock that gets its own chapter in this book, chapter 9. But let's say Jones likes to take his gains. So he sells the stock only to buy it back the next day. Let's say Jones has a 33% combined tax liability at the federal and state levels. Smith, by contrast, lets the stock ride. At the end of 18 years, let's say they both sell their shares for good and they both pay their taxes. Smith now has 3.4 times more than Jones. Taxes matter, and 100 bagger investing is tax efficient. So back to these 100 baggers. Remember, you need growth and lots of it. a fact that I will repeat again and again. Ideally, you need it in both the size of the business and in the multiple the market puts on the stock, as we've seen, the twin engines, as I call them. This means you can't buy a utility stock or large mature company such as McDonald's or Walmart or IBM and expect anything close to a 100 bagger anytime soon, if ever. Finding what will become a 100 bagger is as much about knowing what not to buy as it is about knowing what to buy. The universe of what won't work is large. Knocking out huge chunks of that universe will help make your search for 100 baggers easier. So, with that groundwork, we are now ready to look at the 100 baggers of the last 50 years, actually 52 years, but 50 has a nicer ring to it, and begin to answer the tough question: how can we find the next 100 baggers? Let's begin with some highlights on this 100 bagger population of 365 I've turned up using data from CompuStat, which goes back as far as 1962. The first thing I'd impress upon you is the tremendous diversity in the names. You'll find the entire list and the company's total returns in the appendix. For example, here are the top 10 performers on the next page. And they were Berkshire Hathaway, Kansas City Southern, Altria Group, Walmart, Holly Frontier Corp., Franklin Resources, Forest Laboratories Class A, TJX Companies, Southwest Airlines, and Newmarket Corporation. Berkshire is in a category by itself, and we'll look at it in more detail in Chapter 9. Kansas City Southern is a railroad stock. It's up more than 16,000 fold since 1974. A 10,000 investment there turned into 160 million in 40 years. I would never have guessed a railroad stock would top the list. The second stock on the list is an oil and gas firm that now is mainly a refiner. It's a 14,000 bagger. Some of the other names are not so surprising. Walmart and McDonald's are stocks you probably could have guessed. And remember, this is just the top. There are 365 stocks that have met our 100 bagger threshold since 1962. The 100 bagger population seems to favor no particular industry. There are retailers, beverage makers, food processors, tech firms, and many other kinds. The only thing they seem to have in common is the subject of the study. They returned at least 100 to 1. It's also worth considering the size of these companies when they started their march. Now, I hesitate to make generalizations from the statistics, as I've said, and that's why my focus is more on anecdotal evidence and the ideas or theories behind 100 baggers. With the warning, I'll add that the median sales figures for the 365 names at the start was about 170 million, and the median market cap was about 500 million. That's interesting on two levels. One, it dispels a myth that to get a 100 bagger, you have to start with tiny companies. True, these are small companies, but 170 million in sales is a substantial business in any era. It's not a tiny 50-cent stock with no revenues or barely any revenues. Secondly, these figures imply a median price to sales ratio of nearly 3, which isn't classically cheap by any measure. Going through these 100 baggers, you'll find stocks that look cheap, but more often you find stocks that did not seem cheap based on past results alone. So you must look forward to find 100 baggers. You have to train your mind to look for ideas that could be big, to think about the size of the company now versus what it could be. This doesn't mean you have to have a huge market to address, although that helps. Even a small company can become a 100 bagger by dominating a niche. Polaris was a 100 bagger and makes snowmobiles. Despite occasional exceptions, you do want to focus on companies that have national or international markets. Far more common than niche companies on the 100 bagger list are companies such as Comcast, Aflac, Dollar General, ADP, and Lockheed Martin. These companies came to dominate big spaces, though they all started small. In 1982, Aflac had just 585 million in sales. By 2002, by which time it was a 100 bagger, Aflac had sales of 10.2 billion. Aflac's price to sales ratio, by the way, went from about 1.7 to 5.4. So you had the twin engines, sales growth and multiple growth. Sales went up from roughly 17-fold, and the price to sales ratio went up roughly 3-fold. In combination and including reinvested dividends, they worked the stock up 100-fold. Even if we exclude the dividends, Aflac became a 100 bagger 2 years later, in 2004. Another interesting chart to look at concerns how long these stocks took to become 100 baggers. The average time was 26 years. That was also the median. I divided the time to 100 bagger stats up in 15-year increments, and you can see the results. 60 of them took 1 to 15 years, 180 took 16 to 30 years, about 118 took 31 to 45 years, and about 18 of them took 46 to 60 years. The fastest to 100 baggerdom were Franklin Resources, which took 4 years, Pharmacilics, which took 5 years, Nexstar, Questcor, Biogen, which took 5.5 years, Time Warner, and so on. Case studies. Let's look at some case studies of 100 baggers. This is a way to capture most vividly what it took to get to 100x. For these case studies, I had some help from analysts at Agora Financial, Alejandro Lopez de Haro, Matthew Goodman, aka Yoda, and Thompson Clark. You'll meet them below. Case number 1, Monster Beverage. We'll start with a deep look at Monster Beverage, the famous maker of energy drinks and other beverages. Monster became a 100 bagger in under 10 years. It hit the mark in 2006 and kept on going, turning into a 700 plus bagger by the end of 2014. Yoda, one of the 3 analysts I mentioned above, prepared a case study on Monster. The story starts with a pair of immigrant entrepreneurs. Hilton Schlossberg and Rodney Sachs came to California from South Africa. Both would become billionaires. Hilton and Rodney paid $14.5 million for Hansen's natural soda and apple juice in 1992, Yoda reports. Hansen's had a long history of going back to the 1930s. What started as a business to sell fresh, unpasteurized juices was ironically later turned into a business that sold shelf-stabilized, pasteurized juices by the founder's grandson. Hansen's had no best-selling product. It barely even had distribution in much of the country. But Hilton and Rodney wanted it to become marketing and branding corporation with no in-house manufacturing like Coca-Cola. As early as their 2001 proxy, they made clear that the company is concentrating on marketing carbonated functional drinks, in particular energy drinks. Their initial launch of Hansen Energy quickly became popular but flamed out as Red Bull became the force we know today, Yoda writes. It left Hansen in the dust, but provided some lessons that would later propel some of their finest decisions. For one thing, they decided to slim down their offerings. In 1999 and 2000, the list of products they had was almost absurd, as Yoda relates. Signature sodas in 14-ounce glass bottles slimmed down in 8.2-ounce cans, 13.5-ounce glass bottle smoothies, 64-ounce PET plastic bottled smoothies, 11.5-ounce cans of premium functional smoothies, licensing brands and trademarks, 100% juice in glass bottles, children's multivitamin drinks, and 18 or 8.45-ounce aseptic packaging, gold standard green tea and proprietary 20-ounce bottles, food bars, GMO-free cereal, etc., etc. In 2002, they introduced Monster Energy, which became a focus. And in a 2003 conference call, they said, "We have pulled back a little bit this year on new products." They were very crafty in how they approached it, Yoda writes, with their 2002 annual report revealing that, in connection with the development of new products and flavors, independent suppliers bear a large portion of the expense of product development, thereby enabling us to develop new products and flavors at relatively low cost. Without any internal manufacturing, it was easy for them to test out different products in different packaging because they weren't bogged down with finding the time and money required to run a factory. They felt strongly that differentiated brands were winning brands, Yoda writes. As it would later turn out, packaging was a big part of their success. As mentioned earlier, Hansen's got out to a great start with Hansen Energy, its 8-ounce offering, before losing out to Red Bull. Yoda dug up a response to a question on their Q4 2003 earnings call. The question was whether investors should expect a repeat of the success of Monster. Management said, "Firstly, I think we've learned a lot in the last 7 years. When we started in energy, we came out and we competed initially with Red Bull. At that time, the size of the company was such that we probably didn't have enough manpower and marketing to put behind the brand. In hindsight, we probably should have put more behind it. Red Bull spent for many years disproportionately in the market to their sales in order to establish the brand, and they did a good job." In introducing Monster, Hanson's did not repeat its mistake. Just look at the number of sales and marketing people they added beginning in 2002 when Monster was introduced. Sales and marketing employees in 2001, 66, 63 in 2002, 114 in 2003, 217 in 2004, 363 in 2005, 591 in 2006. Now you know Monster was a great investment. They spent heavily on promotions, marketing campaigns, and sales and marketing employees, Yoda writes. Monster and Rockstar entered the category at about the same time in the 16-ounce niche. Being one of the two pioneers, Monster recognized and seized on the opportunity. Of course, Hanson's didn't just spend its time and money on branding and marketing and new product introductions. They also spent a lot of time focusing on product distribution and the different ways to both reach consumers and earn valuable shelf space with retailers. In its early years, in many ways, it would be appropriate to call them a think tank, Yoda writes. They tried different ways to reach consumers. For their Juice Slam product, they partnered with Costco. With their E20 energy water, they tried to sell directly to retail customers. They even put in the lowest bid on a WIC program, similar to food stamps, that gave them the exclusive right to make 100% of the allotted apple juice and mixed fruit juice that the program offers in WIC-approved grocers. The WIC contract got them in a grocery store that hadn't stocked the company's products before. It opened doors, in other words, for Hanson's products and for ways to create brand awareness. When they decided to roll out a new energy drink line, Lost Energy, they again experimented. Instead of going through their regular distribution channel, they decided to use the Dr. Pepper and 7-Up network. They also took advantage of their brand identity. Their studies showed their drinkers, the 16-ounce energy beverages, tended to be drank by men, Yoda writes. No surprise, given their black can and bear clawed M, they also found that using words like sugar-free or diet were perceived to be feminine, although with light, white, silver-colored cans, according to their data. So when introduced to their Diet Monster beverage, they kept the can black, changed the M to blue, and named it low carb. It was an instant success. Another genius aspect of Monster Low Carb was that it was a much easier sale, as Monster itself was already very popular. They figured out that the only way to get shelf space for a second product is to make sure your first product is in very high demand. And without shelf space for your products, you are just a couple of people with ideas, Yoda writes, and a warehouse full of beverages. Monster Low Carb was one of the first rollouts that really needed almost no promotional support. This was all part of the effort to create a brand which is particularly important in beverages. This all started to pay off in rapid sales growth. Sales and marketing employees between 2002 and 2006 increased almost fivefold. Net sales increased exponentially. Net sales percent of gross and gross profit percent of net sales also increased exponentially. But there is an even more exciting part, Yoda writes. If you have a brand that catches on, grows, and hits scale, the costs start to slowly unwind. Note two things from the above. Net sales grew to a larger percentage of gross sales. That reflects promotions or discounts. Monster no longer needed to offer, as Monster was now a well-known brand retailers wanted to carry. Gross profits as a percentage of net sales also increased as their co-packers and distribution partners started to see them as a good customer and offer concessions to stay. This is a pretty potent cocktail and led to the dramatic rise in share price, Yoda writes. Look at the effect that this extra margin has on the bottom line. And with that, that concludes part 1 of the book. There will likely be 4 parts to this. Thank you for listening to part 1 of the audiobook for 100 Baggers.